you. We'll call this meeting of the Marlborough Retirement Board, July 28, 2020, to order. All board members, please check in and let us know you're present, please.
Diane Smith is present.
Dan Stanhope is present.
Dave Kane.
Bill Taylor, present.
Greg Brister is present.
Can other participants please identify yourselves?
Steve McClellan from Makita's here. I know Henry's jumping on in a minute too.
Okay,
Mike Ossing.
thank you.
Okay, we'll go to item 1, approval of the minutes under tab B.
Motion to approve, Dave Kane.
Motion been made and seconded to approve. Is there any discussion on the motion? Any discussion on the motion? Hearing none, I'll ask the director to call the roll.
Diane Smith,
Yes.
Bill Taylor,
Yes.
Greg Brewster,
Yes,
Dan Stanhope,
Yes.
Dave Keen.
Yes.
All right,
that's passed unanimous, 5-0. Item 2, the investment review from the Makita Group.
Good morning.
Thank you. Good morning, everybody. Are you on, Henry?
Morning, Steve.
Yes, I'm on.
Okay.
All right. Well, thank you, guys. Hope everyone's doing well. And you guys could hear us okay, I assume?
Yes, I can.
Good. Good. We are here to present to you again via Zoom or via conference call quarter 2 report. And I believe Margaret should have received the package from us through Margaret yesterday afternoon.
Yes.
So great. So if you could just let Steve and I have a not a very extensive agenda, but we do have a pretty good amount to discuss on page 2. If you can look at the agenda that we have. And we're going to spend a little bit of time going through the markets a little bit. I'm sure you guys have been following what has been happening with the markets, the way the stock market especially has done what it has done, really recover everything that it lost during quarter 1. And so we'll talk a little bit about that, not to a great extent, but speak a little bit about that and our thoughts as to the speed and the velocity of what the markets have been able to recover. And then we'll spend a little bit of time on just going over the executive summary, what some of the highlights that we've seen within the system. And then we'll go more into details as to what the system actually has done, performance of the specific managers and asset classes, and some of the things that we have done between this meeting as well as and the last meeting that we had. And we've got a couple of current issues. As you know, we did put out an index fund RFP some time ago, and we have gotten the responses. So we wanted to go over the RFP responses. And again, it's been a while, so give you refresh your memory as to why we did this and the purpose of this and what is going to be used to fund this new index and what this index really is. It's not just a plain old S&P straightforward index. It's little more. It's more conservative, and Steve will run us through that. And then the last thing is our annual appropriation that came in July, just to sort of give you an idea as to what we use that money for and how it's invested. So we have several different things that we wanted to cover with you today. And if you have any questions as we go through these items, just stop us, and hopefully we'll be able to answer those questions for you. All right?
All right.
So,
thank you.
Great. So let me just ask you to look at a few pages, and let me just start off with a very broad picture on market returns on page 6. And if you look at these numbers, you look at the S&P 500 for quarter two, and you look at basically all the numbers that you see here from S&P, the international market is represented by the EFA, emerging markets, China, and even if you look at the high yield as represented by Bloomberg, Barclays, high yield returns, these numbers are just unbelievably strong. And the TIPS number, and then look at the aggregate number, which is basically investment grade bonds. I mean, these numbers for the quarter, these are extraordinarily high numbers, especially if you look at the equity market. And for me, it continues to baffle me and a lot of folks because, we have basically recovered most everything that we've lost back in quarter one, as I said before. We saw 40% decline in 1 month, and we saw basically everything come back in a quarter or so. And July, I believe the S&P 500 is up close to 4% again. So these numbers are just extraordinary. And again, what sort of baffles me is that this rebound that we are seeing is coming both for some of the worst unemployment numbers that we've seen, and some of the biggest drops in the global GDP. And as far as the corona pandemic is concerned, maybe what I can see, maybe we're in the fourth, fifth inning at best. In certain countries, we're certainly not even in the fourth or fifth inning. Then at the same time, we've got this tremendous election coming up, looming in front of us, the 2020 election. So given all the uncertainties that we have out there at this point, part of me says that what the markets have done is really has been somewhat irrational. But, if you look at some of the actions that the regulators have put into place, the Federal Reserve, with this monetary policy, there's the fiscal policy, and so on, those numbers have been just unbelievable. And if you just go to page real quickly, if you look at page, let's see what page is that on. There's a page here that looks at all the different stimulus that we have seen, both policy responses on page 14. If you look at the fiscal policy, the fiscal responses and the monetary responses, these have been unbelievable. So if you look at the response on the equity market, you can really say it has been the policy response based on what the fiscal policy has done and what the monetary policy has done. But to me, still, it seems to be almost baffling, and with the way the market is priced today, it seems to be pricing for perfection. So that's what concerns us a little bit, concerns me, and concerns Steve a little bit. But if you look at the next page, on page 7, going back to page 7, and you look at these numbers, this is about as much of a V as you have seen in many, many, many decades. If you look at the numbers here from February 19th peak to March 23rd trough, I believe that represented somewhere around 45% down. And if you look at this number today, we're back at about 32 to 3,300 for the S&P 500. We're not quite at the peak, but we are basically at where we were back in February 19th. And as you can see, what we had done, we have been able to purchase equity for the system back not on March 23rd per se, but somewhere around March 30th, we were able to purchase some equities, and we added something around 5% of the system's assets into equities. Not quite at the bottom, but darn close to the bottom. And as you know, we had this plan to go step 1 and step 2 into higher equity and reduce some of the bonds. But as you could see, as we said at the last meeting, after that initial purchase into equities back in late March, the markets just didn't give us any opportunity at that point to add more into the. In other words, it just went so fast and so quickly. After the initial purchase, we stood back a little bit to see what the market brought. And then if you go to the next page quickly, what happened was in the interim, markets had gotten more expensive, very much more expensive. If you remember, one of the things that we said earlier in quarter 4 2019, one of the things that we said was, yes, we like to be more in equities, but we have to take it very slow because we thought even at that point, the markets were expensive. And look at where the markets are today. Today's numbers look at cyclically adjusted PE or even forward PE. So that green and the blue lines both, as you can see, they are very, very much above the historical average, which is the dotted lines, the green and the blue dotted lines. So if it was expensive back in the end of 2019, If you look at the forward PE, it's even more expensive than it was back then. So this is one of the reasons why we initiated the initial buy back in March 30th, where we sort of hesitated to add more. Now, let me just give you an example why the stock market is more expensive today than it had been historically. So if you look at the, let's give you a quick number. The earnings of the S&P 500 was expected to be about $160 per share, the S&P 500 itself. And that was, let's just use the number of $3,200 for the S&P 500 price. So if you expected about $160 of earnings for the share of $3,200, and if you divide 160 into 3,200, that comes out to about 20x. So in other words, the multiple of PE ratio at back in, let's say, the end of 2019 was about 20 times earnings. Today, the expected earnings for the S&P is now down from $160 to about $120. So the company, people are not expecting S&P 500 companies to earn nearly as much going forward for the next 12 months. So it's down to about 120 expectations. But the S&P 500 is basically back to $3,200. Price has come roaring back to about $3,200 again. But the earnings expected to be about 120. So when you divide 120 into 3,200, that PE multiple is now 26 times. So yes, the market's down tremendously, but it recovered. But earnings did not. So if you were hesitant to buy into equities back in December of 2019, we're more hesitant today to add more stocks today. We were fortunate, if you remember the last page, that to be able to have sort of caught the bottom in March of this year. But that V shape really didn't give us much of an opportunity to add more stocks. But I have a sneaking suspicion that we might be able to find an opportunity here or there coming forward, because, as I said, there certainly is a lot of uncertainty out there still. And at the same time, if you look at the valuations, it is very high. And typically when valuations stay at these levels, we do get an opportunity from time to time to go in and buy some additional stocks. So we are still holding on and looking to see, trying to find more opportunities in order to get into more equities at that point. And having said all that, I know Steve has some thoughts maybe on a slide or two. Steve?
Okay.
Sorry, I had my mute button on. No, I think you got all the stuff I had marked off, Henry.
Okay. And one final page maybe we wanted to spend here is, if you look at page 32, it means, so this data here in the middle of the page, performance year to date, through June. Through June, as it says, S&P is still down about 3%. Global equity is down 11. U.S. has recovered a lot faster than global. Aggregate bonds, meaning investment-grade bonds, up about 6. This means for a typical balanced portfolio, typical 60-40, 50-50 type of a portfolio that most institutions have. Through year-to-date June, it should be down about 2.6%. And as Steve pointed out to me this morning, through July, I should say, through, what's today, July 28th, the markets have continued to rebound. So July's numbers for the balanced portfolio should be up about 3.3. So through July, basically yesterday, most balanced portfolios would have gotten over that negative territory and should be either flat or slightly up through the end of July so far. Okay, but it has been a very difficult year to date, losing about 40%, gaining back about 40% on the U.S. equity. But international and emerging markets not doing as well. But you'll see a little bit later on, emerging markets have come back very strongly in the month of July. And there's a reason I highlight that, because we'll talk about where the appropriation assets went to a little bit later on. So any questions about what the markets did and where we are today?
No, I have none.
Okay.
Any other board members have anything?
No.
Okay.
Oh,
Okay,
Okay. Great. So let me then ask you to move to page 34, just a quick executive summary. And as it says here, we returned somewhere around 11.6, about 4% during quarter two, I should say. And it matched the primary benchmark of 55.45 of stocks and bonds. And the quarter market value was at about $178 million. And the reason why we didn't do better was basically comes down to the performances of our two active U.S. equity managers, Fiduciary Large Cap and Frontier. They severely underperformed most of 2020, although you'll see a little bit later on that Frontier did have a very, very positive quarter two return of about 33%, but it still trails the benchmark year to date. Now, you'll also see a little later on, next page, most of the asset class aggregates, meaning our international equities, our investment grade bonds, our high yield and other asset classes that we have, we either matched or outperformed the asset class benchmark. So for most part, our assets and our investment managers that we've hired for specific asset classes, they've done well, with the exception of, as I said, U.S. equity, which is a big blow because simply put, it is the largest bucket that we do have. And one of the things that we'll talk about is Fiduciary Large Cap, because that was one of the ones that we had, quote unquote, in a watch for a while. And one of the main reason, I should say, that we initiated this RFP late last year, early this year, was specifically due to our feelings and our thoughts on Fiduciary Large Cap. And again, Steve will talk a little bit more about that. Another thing, that major activity that we had was there was approximately $9 million of appropriation that came in July. And we recommended, and it actually was implemented, close to $6 million, about 67% of the $9 million we recommended being invested in emerging markets. And about $3.5 million was placed in cash for future benefit payments. Now, this is a short-term return, but the money actually was invested in early July, and through July, it says 7% month to date during July, but that number is actually at about 8.3, 8.5%. So the money that we put into emerging markets appropriation of about $6 million had a return of somewhere around 8% in 1 month. So to date, the investment decisions that were made with appropriation seems to be the correct call. And the last thing is that we did finalize the RFP and the effective index to replace Fiduciary Large Cap fund, and we do have some recommendations as to which provider we think would be the best for this so-called defensive index fund that will be used to replace Fiduciary Large Cap. So, quick executive summary, some of the highlights and some of the activities that we had. Okay, and if you go to page 37, this is the allocation versus the target. And just a quick reminder, we've got a lot of columns here. We've added a few more columns than we had in the past. And what you see here is the current balance, which is the first column, and the old policy. That was the policy that was in place prior to the board approving the step 1 and step 2 policy that we had. The third column is the current allocation where we are today. And step 1 and step 2 is they are the allocation policies for what we would like to get to, which is basically step 2. And step 1 is an intermediate kind of a step. And as you can see, our current allocation right now, U.S. equity is 38%. We increased that from what was at about 33, 34% back in earlier this year. And we're not quite, well, we actually, with U.S. equity, we're at 38%. But as you can see, if you go down to investment grade bonds and go to chips, you'll see that we're still not quite there as far as reducing our most conservative assets at this point. And we're doing that because, as I said, there is still some uncertainty out there, and we don't want to rush and divest ourselves of the most conservative or more defensive assets at this point. But as you can see, we are somewhere between new policy 1 and new policy 2. It's still not quite there because there is some, there's obviously some uncertainties out there, and we don't want to get into that most aggressive step 2 policy at this point, but we're slowly inching our way to the policy 2. Okay. And any questions on this? I know this was new, and this is a new slide that we included because I wanted to just make sure everyone understands that we're no longer basing our allocation to the old policy, but we're moving to policy 2, but we are sort of in between policies 1 and 2 at this point, and slowly making our way to that final step of step 2. Okay.
I have no questions. Thank you.
Okay, and then page 39, just looking at the performance quickly. And as you can see here, quarter-to-date number for the system, we're up about 11.6. And here, what we decided to do is add one more row of performance as a benchmark. We have been using 55, 45, which is that first benchmark return. But we included 45, 55. And the reason for that is even though we had a 55% equity target and 45% bond target, historically, we had been very much less equity than that 55 would suggest. And if you go back historically, because of the conservative structure of the system, about 45 is where equity position had typically been. So even though the policy stated 55, reality was that about 45% of our assets were really invested in equities. So we decided to add that to get a comparison as to how we would have done not just the 55 equity policy, but 45. And as you can see, so far this year, year to date, we're down about 2.6%, and we are underperforming the 55 as well as the 45. And we are slightly below median of our peer group, which is public pension plans of $50 to $250 million. And as I said, the main reason, as you can see, is domestic equity returns year to date was down 9.8% versus the Russell 3000 or the benchmark for the U.S. equity of down 3.5. So as you can see, that is the biggest detractor we have. About 38% of our system's assets are in domestic equity, and it underperformed its benchmark by about 6%. And Steve will pick that up and talk a little bit more about that in detail. But if you go out to the longer term numbers, let's say out to 5, 10, and 20-year columns. If you go out to the 5-year column, the system's return was 5.5, and you can see that the peer group of $50 to $250 million pension plan is at about 5.8. And if you got to 10 years, 7.6, and the median is 7.6. And going out to 20 years, you can see that we have outperformed the median of the peer group by 40 basis points. So we have more details on this a little bit later on, but as we go back further, longer term period numbers, we have been able to outperform not just the peer group average, but also we have been able to outperform the 55 as well as the 45. Specifically, if you go out to, let's say, 10 and 20 year numbers, the retirement system was up 7.6, and the 55 benchmark is up 7.4, and 45 benchmark is up 6.8. So longer term history, we have been able to do a pretty darn good job keeping up with the benchmark as well as the other peer group. But as you can see also, year-to-date numbers for the other asset class aggregates, such as international equity, we're down, I should say, 10.9, and the benchmark is down 11.3. If you go to the emerging markets, we're down 8.3, but the benchmark is down 9.8 for the year-to-date column. So if you go down these year-to-date numbers for aggregates, aside from domestic equity, we have been able to, as I said, either match or do better than the benchmarks themselves. So year-to-date number, as this shows through June, we're down about 2.6. And as I mentioned earlier, Steve's calculation earlier this morning shows that we're up about 3.3 for the month of July. So year-to-date, we should be up about little over 1%. And we are now on the positive side of the ledger. And as I said, it's been difficult here so far, simply because of what's been happening to our two largest holdings, which is in the domestic equity with Fiduciary and Frontier. So with that, let me hand it to Steve, and he can maybe spend a little bit of time on specific managers and reasons why Dave were not able to do as well.
Sorry, I got a quick question.
Sure.
On the benchmark for the public
Right.
benefit plans, do we know what their asset allocation mix is?
We do. It's not
Is it
on
similar
this.
to ours?
It is, no, yeah, I would say typical asset allocation for this benchmark would have somewhere around 55 to 65% in equity. So they do have more equity than we do by
Okay.
to the tune of about maybe 5 to maybe 10%. But
Okay.
we can certainly get more detail on that.
I'm glad you brought it up because that's one of the big pitfalls of looking at peer analysis. I mean, it's like fine, it's all right to look at it just as an information point. But the thing about peer analysis is you actually have to have a group of peers, and in a lot of respects, in terms of risk tolerance, I would say that they're probably not your peers in a lot of, just thinking about it in a couple of different ways. So it's good informationally. You can kind of get a look at how other people are doing, but know that your allocation for most of your history has been significantly more conservative than this peer group. And that's also true of the Massachusetts retirement system space. So, when you get the performance reporting from PARAC and things like that, generally you'll see for the system, you'll tend to do better in years where the market sells off because you're more conservative, and you'll tend to trail your retirement system peers when the market is up. But it's
And if you recall the last meeting that we had, and we shared with you the returns through Q1, and that was the end period was the disastrous Q1. And if you recall, again, within that peer group, because of the conservative structure of the system, our numbers, by not mistaken, were probably up in the close to or the top 20-25%. So again, when markets do poorly, and because of the historical conservative structure of the system, we look really good. But when the markets are roaring like we've seen so far this quarter, I mean, who would say that having an 11.6% return in 3 months is not a good number? But if you look at it against some of the other systems similar to this, in a sense that the size, nothing else but the size, and the average system of this size returned about 12.4. Again, that's the difference between having about 5 to 10% less in equity when the equity markets are up 20+%. So again, as Steve mentioned, the peer group is the peer group because the size. That's the only factor that has common with Marlborough system, is that this peer group is in the same size range, and it doesn't have anything to do with the way the board feels or what the risk structure or anything like that. It just simply has to do with the size. Okay.
So I'll jump into just talking about some of the individual manager performance. I'm gonna try to keep it relatively quick because I know you all have things to do later today, but it has been a pretty topsy-turvy year so far. So I'm just gonna go through fast, give some high-level comments, and then sort of give a gut check. So talk about whether this is something we expect or not something we expect. And I'll start on page 40. You can see your domestic equity portfolio here. As Henry pointed out, there's a significant amount of underperformance year to date here. Just going down the list, you can see the index has actually done pretty well over the year to date period. It's certainly outperformed the active managers that make up the rest of the portfolio, as well as being generally ahead of the index. I guess the Russell 2500 growth is because it has that growth inflection, has done better over the year-to-date period. But if you were just to look at mid-cap equity, so that's your mid and small caps that are in the Russell 2500, the S&P 500 is beating the core benchmark of that. So that's a little under half of the domestic equity portfolio, and that's actually been performing okay. I'm going to skip over fiduciary for a second and go down to Frontier. I think we haven't seen you folks. So for Frontier, basically the story about what's going on here is that one of their biggest positions, and one that was actually quite profitable in 2019, was they had a lot of airline stocks. And if people weren't on mute, I'm sure I could hear people groaning, because I mean that was clearly not the sector to have a huge position in going into this year. I'm not sure that we necessarily fault them for that. At the end of 2019, airline stocks were actually in some of the best financial shape they had been in, years. I kind of want to say decades. They were actually in very good financial shape, and we had COVID smashed down on us, and that's not great for airline stocks. That being said, you can see in the quarter to date period they've recovered pretty smartly. They're up 33%, which is not nothing. And the nice thing about that is that it's not just because airlines bounced back a little bit. They actually rotated out of some of that name, so they cut back on a few of those holdings. And we're actually seeing growth from both their financial positions, which is interesting because financials actually did really poorly, and we'll talk about that more with fiduciary. But they had an underweight position to financials, which was good because financials didn't do well, and the companies they did have performed very well because they're kind of more tech focused, more payments focused, which has been really a good place to be during the pandemic, because a lot of restaurants and other folks are trying to put together payment solutions to be able to take money for things from curbside pickup or doing takeout where they normally wouldn't have done that in the past. So for Frontier, the number is not great year to date, but we have a pretty good handle on why it is the way it is, and it's not them kind of messing around or getting outside of their area. It's just, who would have known back in January, right, that the entire airline industry was going to get smoked for 4 months? It's not something reasonable to know. By contrast with fiduciary, as Henry said, and we're going to talk about the RFP that we issued as well. This was a manager we already had concerns about at the end of last year and early this year. We were doing a search to try to get an exposure that's similar to how we wanted them to perform in this portfolio. So fiduciary's position here is supposed to be defensive. If the market is strongly down, they're supposed to protect somewhat. That was our prior experience in the global financial crisis. They mostly managed to protect on the way down and then actually recovered pretty sharply in 2009. And you can see that's not the case here. When you look at their positions, there's a lot of financial exposure, there's a lot of manufacturing exposure, there's a lot of retail exposure. Those are not places that have done well, I think, for somewhat obvious reasons. And again, this is a manager that we did express that, we had some concerns about coming into the year, and we're looking to potentially replace anyway. It's unfortunate that, we were talking about doing that, I think, at the end of February, but we have a process we have to go through to do procurement, and, we're going through that now. I'm not going to lie to you. I wish we could have done it in March, but, it is what it is. There's no getting around that. But fiduciary, I would just say in general, has not played the role that we had set out for it. So I just want to, I'm going to go through a couple of other managers, but I just want to give a second for questions, because that's the biggest area of the portfolio, and it's the biggest area of underperformance. So if anybody has further questions about that.
Are there any questions from the board members?
Sounds like none, so I'll just continue quickly. Thank you. So flipping over to the next page, I'm on 41 of 101. You can see I'm going to skip over developed markets because that's an index. In international emerging markets, we actually have outperformance over the course of this year. So the second quarter, we have outperformance as well as year to date, ahead of the index by about 1.5%. And this portfolio is actually working the way that we would expect it to. You have two managers. One of them is a growth manager. So Driehaus tends to invest in growthier, kind of faster moving companies, whereas DFA tends to invest in value companies. They're a bargain. And DFA, so value has been a bit out of favor. You don't see it here because they're benchmarked to the same core benchmark. There's no value or growth inflection in it. So they've tended to underperform. That's something that we're comfortable with. It's consistent with what their investment process is. Whereas Treehouse, it's more growth focused. You can see that they're running pretty well ahead of the core benchmark. I mean, over the 1 year rate, they're ahead by about 8.5%. And that's why we pair them together like this. The thought process is whether it's a growth market or a value market, if you have a growth manager that's especially good at growth and a value manager that's especially good at value, and then you give each of them half of the portfolio and rebalance between them, no matter what the market environment is, you should be able to generate an excess return over the long term, which has been the case here. So if you go back to the inception of the EM portfolio, actually right around the time I started working with you guys, I think I joined like a month before it got implemented, you're about 1% ahead of the index on a long-term basis. Going over to page 42, you can see Schenkman Capital. They're the only high-yield bond manager you have, and they are a fairly conservative manager, and that's on purpose because they're running the whole high-yield portfolio. We try to make that position not too risky because they have the whole chunk of money. And basically, you would expect them to protect in down markets and then to lag a little bit in up markets. And that's actually what you see here. In the first quarter, they protected pretty well on the downside, and then they've lagged a little bit as things have gone back up. But on a year-to-date basis, you have about 70 basis points in excess return against the high-yield benchmark, which is exactly what we would expect out of these guys. And then my last manager I'll talk about for EM debt assets, you can see Payton down below there. They are a little more aggressive, I would say, in profile than maybe somebody like Schenkman. And you can see it here, right? It's the exact opposite. They're down a little bit more in the first quarter versus their benchmark, but they've also recovered better in the second quarter. So it's something where I would love it if they were positive for the year, but they're not doing anything that's totally outside the parameters that we would have established for them. And so that's the end of my manager commentary. I'm gonna talk quickly about just your risk positioning. That's on page 47. This is a chart. We started showing it a couple of years ago. It's basically what these charts are telling you is for various time periods, 3, 5, 10 years, and since inception, how your returns, which are on the left-hand side, compare to your level of risk, which is that axis along the bottom. And the thought process here is that you want to be in the upper left quadrant. So that if you're in the upper left, that means that you're having high returns and you're not taking much risk. Where those lines cross, there's a little dot on it. That's the 55-45 benchmark that Henry was talking about earlier. So if you can be up and to the left of that, that means that you're getting more return with less risk than the public benchmark. You can see in the more recent periods, we're either, for 5 years, we're either on that dot or we're a little bit down into the right. That's not where you want to be necessarily. I think that there's a lot of endpoint bias in that. A lot of that is being driven by the fact that we've had poor performance very recently, as well as the fact that we're underperforming pretty significantly in the U.S. equity bucket. However, if you look at over the longer term, and this is true over 7 years as well, so it'd be 7 years, 10 years, and since inception, you can see that you're still pretty much up and off to the left, which is where you've historically been. It's been one of the messages we've had for you over the last several years is that even though you run a conservative portfolio, you tend to get higher levels of return for the level of risk that you take. And it's helped keep you in the game, quote unquote, to in an actuarial sense where your asset allocation mix until we talked about it this year has always been kind of more conservative than, not more than the expected return you're targeting, but it's kind of right on the nose, or maybe it's a little bit on the lower side, not crazily so, but a little bit lower. But you've gotten returns that have exceeded that, and that's what these charts are showing for you. And then I'll close out performance on page 48. You can see peer returns here. So this is it's a little more context for the number that we were talking about earlier in terms of the peer median. You can see more recently, it's not fantastic. In the year-to-date period, you're about on the median, and a lot of that's being driven by very recent performance in the last couple of quarters over that year-to-date 1 year and 3 year period. You can see over the longer term that you tend to be, over the 10 years and 20 years, you tend to be either at the median or up towards the first quartile. And that's largely a result, again, of that long-term trend of outperforming your level of risk. And then also these peers tend to be riskier than you. So if you as a fairly conservatively positioned system can get up to the median or even exceed it over the long term, that's actually pretty good. Some people look at the median and they're like, oh, well, why am I at the median? Shouldn't I be doing better? Shouldn't I be number one? But if you're not taking the same level of risk as everybody else, that's not really an expectation we'd have. Like usually people over the long term that take more risk get more returns. So the fact that you're not taking lots of risk and you're getting the return is actually a good indicator to us. All right, I said a lot of stuff. I talked really fast. Does anybody have any questions about any of the manager stuff or this peer analysis before I jump into the index search?
Are there any questions from the board members?
I have none.
Nope.
Okay, thanks everybody. All right, if there are no questions, I will jump into the index fund search. And I'll start on page 81, and I'll just give you the background myself. So as I alluded to when we were talking about fiduciary, we were, what's a nice way to put it? We were a little bit hesitant to embrace their sort of position as a defensive part of the portfolio. We were looking to see if we could get an index fund, so an index fund in the sense that it's systematic and it's something that's quantitatively determined to get a certain set of exposures. You have the S&P 500 index that's basically, let's go out and find the 500 largest stocks in the US, and that's going to be our portfolio. We were trying to find a strategy that's similarly quantitative and transparent, but in a way that would give us a defensive exposure like what we wanted from the FMI portfolio. And when we look for that, we look for two things. We look for low volatility. So low volatility means when we look at this portfolio, we want it to not be as volatile as the reference benchmark. So in this case, we're replacing a large cap manager. We'd want something that is, it consists of large cap stocks, but it doesn't move around quite as much as the large cap benchmark. And then the other thing we look for is we want quality companies. And there's a couple of different ways. One of the ways that these different respondents kind of distinguish themselves is how they think about quality and how you kind of quantitatively define that. But we look for quality because sometimes you have low volatility stocks where their price doesn't move because they're just not very good companies. They're consistently not great companies, so their stock price is not volatile, but it's for the wrong reasons, right? It's kind of the difference. I want to get a good deal, but I don't want to be dumpster diving. So what we look for here is you can kind of combine both of those attributes to get a portfolio that hopefully will reduce the risk that you take. And we want to do that for a couple of reasons. One, because just we don't like taking risk that isn't compensated. But additionally, as Henry mentioned before, if we're increasing your equity allocation from a relatively conservative allocation, we want to do that in a predictable, steady way. And we want to put money into areas of equity that are not going to be super volatile. If we had met in February and we just rebalanced the whole portfolio at the end of February, that would have been not great, right? So we want to find a risk-controlled way to try to up your exposure to equity and still get that equity upside without drastically increasing the overall volatility of the portfolio. Now, so we did that. We put the RFP out. We got your respondents. We got 9 respondents. I threw out the most responses I think that I've ever thrown out in an RFP, and I just want to go through them because I don't usually do that, but this is kind of unusual. We had 2 respondents that weren't actually responsive to the search. So one of them proposed global equities. This is a US RFP, so that's not super germane to what we're trying to do here. The other one was not, it wasn't passive. It's, we generally for a passive portfolio, it's relatively systematic and quantitative. The T. Rowe Price portfolio, it's not that. It's basically it's allocating money among research analyst ideas, which, it's a fine strategy, but it's not really what we were looking for in the AUM, in the RFP. And then our last respondent didn't meet the minimum criteria. So generally, I don't throw out 30% of the respondents, but in this particular case, I mean, they were just kind of off the mark a little bit. So that leaves us with 6, and you can see them in the top of this table on page 81. We have 2 highly advantageous, 2 advantageous, and 2 not advantageous. And I'll just say at a high level, sort of why folks fell into the buckets they did. The not advantageous strategies, I want to clarify that when we give these rankings out, these are rankings in the context of your portfolio. So these are not advantageous for you. Milliman and the QMA strategy, they have a very, very large volatility reduction. For one of them, it's actually half as volatile as the overall equity market. And that's not necessarily the profile we were looking for you guys. We want to have it be a little less risky, but we still want you to participate in the equity upside. This is still an equity mandate. The products that those 2 firms pitched are more, I'd say they're more appropriate for like a corporate plan where they, think about sort of like the duration of their holdings and try to match off their liabilities, and they can, they have more scope to use a product where it has half the volatility of the equity market. Whereas for you, we mostly want you to participate in the upside, and we just want some moderate defensiveness on the downside. And then for the advantageous managers, they generally do what we were looking for. There's just a little bit of, there's like a couple of small things with the approaches that maybe make them a little less good for you than the top managers we ranked. You can see Comerica, so that's your custodian. They actually put forth using the S&P 500 low vol index. That, it's good. It has like a low volatility. It does what it says on the tin. The only thing about that index is that you get really high sector exposures. So like, I don't know what it is right now, but like historically, like a quarter of that portfolio ends up being like utilities. And that's not, we don't want that much tracking error in your strategy. And then the Wells Fargo, the analytic strategy, that's actually a strategy we have other clients use. It just has a really big value bias in it. And I don't know that that's something we want where you only have 3 exposures in your portfolio. We want something that's defensive, but we don't necessarily want to put a value tilt into the portfolio. So they're actually decent options. They're just not decent options for you necessarily. So I'll go through the 2 highly advantageous ones and just kind of explain where they're coming from. So the first one of those is Northern Trust. Northern Trust is a custodian, primarily a custodian. They also have an asset management business as well as brokerage and wealth management. And this is a team that we've been following for a number of years. It's kind of funny. So these 2 highly advantageous managers, they've actually, when Makita has had mandates like this in the past, these folks have been doing this for a long time, and it's not unusual for both of them to end up in situations like this, even not using an RFP process. Northern Trust has been at this since before, the early 2010s. That's pretty much the beginning of when you start to see products like this come out to the market. It's been discussed in academia longer than that, but when you first started seeing product actually get made, that they were essentially in at the beginning. And the process and the philosophy are really straightforward. Basically, they're just taking all the large cap US stocks, They look for those that have low vol characteristics and quality. So that's not something that always happens. Sometimes people take low vol stocks and pick the highest quality ones among them, or vice versa. They look at both simultaneously. And then their quality, what they think of as quality, is management efficiency, profitability, and cash flow generation. And all three of those quality signals are pretty well supported in the literature. So it's a good process. It's pretty intuitive, and it gets what we're looking for in terms of low volatility exposure. So you're getting about a 20% reduction in volatility. So it's moving about 80% as much as the underlying benchmark, and you end up with a tracking error of about 3 to 5%, which is right in the neighborhood of what we'd be looking for you. The price is not bad, so it's only 15 basis points, and that would be in a commingled fund. They offer separately managed accounts, but I don't think that it makes a lot of sense economically. The other highly advantageous respondent is Rumline. They're on the next page. You know Rumline, they do your equity indexing for you. You know, been very happy with them just in general, or I have. I don't know if any of the board feels differently, but I think they've done a fine job for us over the years. And this portfolio actually has very similar exposures, and it gets there in a fairly similar way. Basically, all it does is it takes the Russell 1000, which is U.S. large cap stocks, and it gives every stock in that index a score. Half the score is based on volatility characteristics, and half of the score is based on quality characteristics. And the quality characteristics are a little bit different from what Northern looks at, but when you combine them all, it ends up getting names that are fairly similar. And you also see that for this portfolio, it gets similar amounts of volatility reduction. So again, it's like 15 to 20% volatility reduction, 3 to 5% of the tracking error of the underlying index. The fee here is more advantageous than Northern. So there's 2.5 basis points that go to Rumline, 2.5 basis points that go to FTSE Russell, who makes the underlying index, but it's 5 basis points. The only kind of rub on this is there's no commingled fund option. So most of your investments, they're in a fund vehicle. They're either in commingled funds, CITs, or they're in mutual funds. This one does not. You would have to open up a separately managed account. So we'd have to go to Comerica and say, hey, we're going to give you $1,500. We're going to open up this account, and we're going to pay for our own trading and do that thing. It's a little bit more administratively complicated, but Rumline is willing to do that for you because you're an existing client. You're a longtime client. You've been a good client for them in a number of different ways. So that's the Rumline.
And also Rumline, we have spoken with Rumline recently, and we have several clients at Nikita that have gone into this specific FTSE Russell 1000 heady moderate portfolio. And at this point, with the amount of assets that are here in separate accounts, there certainly is enough for Rumline to create a commingled fund. And I don't think I'm speaking out of turn, but it is likely that Rumline will create a commingled fund by aggregating all the separate accounts that they have right now. So it is very likely that towards the end of this year, maybe early part of 2021, we will see a commingled pool, basically based on this Russell 1000 heady moderate index from Rumline before, let's say, within the next 12 months. So we will have a commingled pool most likely if we push Rumline to create one.
Yeah, that's the hope. It's not in the proposal, but I know that their asset level has gotten to a point where it economically makes sense. It's just a matter of kind of making it work logistically. So the next page, I'm not going to look at any of the other managers in detail unless anybody wants to, and we can go back and do that if you'd like. But on page 89, you can take a look at the trailing performance as well as the risk statistics. And this is just putting numbers behind what I was just discussing. So one way to think about this is if you're looking at the performance, you can look at Q1 of 2020 and see how they did, because it was a pretty, we're looking at defensive portfolios, and it was a quarter where you wanted some defensiveness. And just kind of going down the list there, you can see Milliman and QMA, those were the folks that I mentioned, like they're defensive, but they might be too defensive. And you can see they are quite defensive. QMA was only down 4% in the first quarter. The Russell 1000 at the bottom there was down 20.2. Milliman was down about half of what the Russell 1 was down. That's good, and like it's good over that first quarter. The problem with those approaches, right, is if you look out over the longer term time period, so if you go out to like 5 years or so, generally those strategies are not returning quite as well. So like QMA is underneath the Russell 1000, and Milliman doesn't actually go back that far, but I think that if you were to look at their process, it would probably be the same story. They're not going to get an equity-like return. Contrast that with Northern Trust and Rumline. They were not down as much as the reference index. If you look over the 3 and 5 year periods, in some respects, they actually do better, right? So Northern Trust over the last 3 years was up 6.9%. Rumline is up 7.9%. The Russell 1 was only up 4.6% over that same time period. Northern Trust in the 5 year time period is 8.1%. Rumline's 8.8%. And that's versus 6.2% for the Russell 1. So that's nice, right? Because you're getting that downside protection, but you actually have an excess return with those strategies over the more moderate length time periods. And that's borne out in the risk statistics down below. I'm not going to go through all of these, but I think the ones that you'd probably be the most concerned about are beta and tracking error. Beta is, how much a manager moves with the market, and tracking error is a way to measure how much they move against their benchmark. And you want a beta that's somewhere in the neighborhood of like 80%. That's what we were targeting here. And you can see Northern Trust and Rumline fall into that bucket. If you look all the way on the right, you can see upside and downside capture. All those are saying is upside capture is saying, hey, when the market's up, how much of an up market do you manage to get? And it's the opposite for downside. If there's a down market, how much of the down market do you get? Ultimately, you want to get more upside than downside. It's what you would think intuitively. And both of those strategies manage to do that. I mean, you can see Rumline actually participates 95% on the upside, but they're only down 80% or so of when the market is down. So that's kind of why those managers ended up on the top of the rankings. I'm not sure how the board wants to proceed here, because these strategies are a little bit of a blend, right? Like they're kind of an index manager, but they're not quite as straightforward as an S&P 500 index. We could have the folks come in and give their pitches. It is an index fund though, so we could make a decision today. I'm not sure, how you want to handle that. The other thing that kind of complicates this is ideally for you, given the amount of money you're investing, I would love to put you in a commingled fund because you get some economies of scale. It makes life a little bit easier for Margaret. It's not as logistically intensive, but at the same time that Rumline strategy is very attractive. You can see here it has good performance, it has good risk statistics, and it's actually cheaper than Northern. So I guess I would look to you for some guidance. I don't know if you want to talk to these folks more about what they do, or would you be more interested in trying to make a decision today?
And if you were to ask, I'm sorry, if you were to sort of say, what do you think? And we've had specifically Rumline in several of our clients that actually put the money in this specific strategy at Rumline at 5 basis points in a separate account. And it has been very successful during this downturn, as well as the recovery that we've seen. So I personally am a big fan of Rumline for that, as well as they're local and they are very, very responsive to all of our questions and all of our needs. So if you were to ask us, what do you think? I would say, for me personally, I would put Rumline at the top of this list by a little bit over Northern Trust.
I would be comfortable recommending Rumline, just given our long history with that company. We've had some good success with them. I see no reason why we can't just go with them. If you think that's a viable option for us, I think that's what we should do.
No, Bill, I agree. I don't see that we should hold off on this, to the next meeting. I feel the same way. I think we should go with Rumline.
How much are we talking about allocating to this?
We're talking about fiduciary's assets, which I believe the exact dollar amount in fiduciary is, what is the number?
It's in the neighborhood of 25 million. I think it's a little lower than that now, but
Yeah.
it's in the neighborhood. I think we put the search out at 30, but I think it's come down to about 25. But that's the way to think about it, is that it'd be a slot in for fiduciary.
Mm-hmm.
Is there anybody else want to be heard on this? I agree with Rumline as well from their past experience and performance with us.
Yeah, I mean, I wouldn't mind hearing from both of them, but I guess because we have history with Rumline, if we were just giving 25 million to somebody new, I wouldn't feel comfortable without vetting and hearing from both of them first. But I could be okay with giving it to Rumline because, like you all said, we have past experience and good performance with them.
Right. I agree with that as well.
Yeah, my opinion is just concurrence. I just don't want to pile on to what's already been said.
Okay.
Very good. So we will, I don't know if we need a formal vote on that, but we will.
We do.
We do? Okay, sorry, I interrupted then. Sorry.
No,
Go ahead.
that's okay, but yes, we do need a motion. And
I'll make the motion.
Motion's been made to go with Rumline.
Second, Dave.
Second, I'll ask the director to call the roll.
Diane Smith,
Yes.
Greg Brewster,
Yes?
Dan Stanhope,
Yes.
Bill Taylor,
Yes.
Dave Keane.
Yes.
Vote is 5-0, unanimous. Okay, Steve.
Sorry, I'll go on.
We'll work with Rumline and fiduciary and Margaret to have the assets transition to Rumline. And Rumline has been able to take the assets in kind from fiduciary and other active managers and trade the account to make it look just like turn the active stocks that FMI holds, fiduciary holds, and turn it into the Russell 1000 heady index. So we'll just transfer the assets over to Rumline, and they'll just transition the portfolio to the index fund. So that's the process that we have employed in the past, and it has been very efficient.
Yeah, we'll work through that. This is a mutual fund that you're coming out of, so it could be a little bit. Yeah. We might have to take cash. I mean, we can. That's one of the things we'll talk to FMI about is whether does it make more sense to get cash or does it make more sense to get securities and have Rumline sort of reposition the portfolio. But we'll work through that process. So thank you for listening to me, everybody. And I think the last thing is just Henry was going to talk about the appropriation, although I think we addressed it. But
yeah, and it's just real quick. I think it's on page 92. Really is
Henry, just before you continue, I think Margaret.
Oh, actually, I just had a very quick question. How fast is PARAC turning around approvals on new managers?
It's been pretty slow.
Okay.
They are down a significant amount of staff over there. I don't say that to rag on them. I know that, they're working remotely, which kind of slows things down sometimes anyway. And then I think that their staffing is a little low at the moment.
Mm-hmm.
So,
Okay.
you know, in theory, by law, they have 10 days to give a yes or no. I mean, that being said, you know, I think they're doing the best they can with the resources they have. But you know, we'll work with them too. This won't be like the first time that we've had to try to work something through. So, but yeah, it's been kind of slow over there. I'm not sure if you've had other issues that have that, you know, that you've been trying to work through with them on the liability side of the ledger, but I know the compliance unit in particular is low on headcount at the moment.
All right, so hopefully maybe we can get the approval quick and get things moved over.
Yeah, it'll take a little bit of time because we're gonna have to get the separate account set up at Comerica too, and I'm not sure how, you know, I don't know that I've set up a separate account with them recently, so we'll have to see how logistically intensive that is, but we'll you know, we'll get through it. I'm sure that everybody will be able to get us where we need to be.
Thank you.
Thank you.
And the last item is real quick. It's on page 92, and as we have typically had in past years, about this time of the year is when the appropriation comes out, and we put together a recommendation and and put it in a memo to Margaret and to the board. And this is something that we do on a regular basis, but we also do this more or less every couple to 3 months for the benefit payment. You know, where the question is, okay, we need a couple of $3 million. You know, where should we take the assets from to make the benefit payment? This is the same thing, more or less. But here, we're expecting about, well, we were expecting at that point, as I said, around $9 million or so, $8-9 million, and our recommendation was to put it into the 2 emerging markets and leave about a third of it in cash, and that's what we had done. And as I mentioned earlier, so far in the month of July, since the assets were invested into emerging markets, the emerging markets as a whole is up about 8.5% so far. So the assets that we've invested in that has grown to about, you know, by about 8%. But this is something that we do on a regular basis, and remember that we send that to Margaret as well as to the rest of the board. So just wanted to give you an update on how we you know, how we deal with the appropriation as well as the benefit payment request that comes in. So just wanted to just share this example of a memo that we send out, and to just give you an idea how systematic that, you know, the whole process is, whether we're getting money in or money going out to pay the benefits. So that is sort of the end of our prepared remarks today. As I said, numbers were a little disappointing this quarter because of the 2 domestic equity managers, Frontier as well as the fiduciary. And fiduciary's numbers, not only were they disappointing, but they were not what we were expecting. That's not the expectation that we had as far as, you know, potential outcome. Whereas Frontier, they were disappointing, but they're certainly within the reasonable expectation that we had for the type of a manager that they were. So, you know, our thought was to replace fiduciary with the one of the more defensive index, which the board just approved, and we'll make the transition to them as soon as we can, given the regulations that we have to follow. So with that, any questions on what we presented today?
Board members, any questions?
Nope, I'm good.
I'm good.
Okay. Thank you, Henry. Thanks, Steve.
Thank
All
you,
right,
guys.
thanks, guys. Any questions, you know, just reach out to us.
Okay.
Thank you.
Steve,
Okay,
and
guys.
I want to thank you guys for your continued updates throughout this process of COVID-19. You've been very good with the office staff and myself. I appreciate it very much. Thank you.
Thank you. We appreciate you, you know, trusting us. Thank you.
Yeah, we're happy to do it. It's a tough time. It's still a tough time. So, you know, we're happy to, if that can make everybody maybe not feel better, but feel a little bit more comfortable, we're happy to do it.
It is. Thank you.
Okay.
All right.
Bye now.
Have a good rest of the day.
Take care. Bye.
Thank you. go to item 3, approval of retirements as submitted. We have 4, I believe.
Yep, we have four individuals who applied for superannuation retirement. They retired in June. They're scheduled to get their first retirement check July 31st.
Motion to approve.
Second.
Motion's been made and seconded to approve as submitted. Is there any questions? Any comments on the motion? And seconded, the director will call the roll.
Bill Taylor,
Yes.
Greg Brewster,
Yes.
Dan Stanhope,
Yes.
Dave Keane,
Yes.
Diane Smith.
Yes.
Does carry 5-0. Item 4, approval of refunds and transfers. As submitted, we have 3 on the agenda.
There's nothing unusual here. The last 2 are basically housekeeping items, and a refund application for Christine Formosa, scheduled to go out August 1st.
Chair will entertain a motion.
Second.
Motion been made and seconded to approve the refunds and transfers as submitted. The director will call the roll.
Greg Brewster,
Yes.
Dan Stanhope,
Yes.
Dave Keane,
Yes.
Diane Smith,
Yes.
Bill Taylor.
Yes.
Does carry 5-0. Item 5 on the agenda, new business, old business.
I just want to give you a brief election update. Nathaniel, as you know, is your election officer, and he has sent out, or will send out, the notice to retirees via the paychecks. Notice to the employees was sent out via an email through the mayor's office. Nathaniel will also be sending out a notice via mail to our inactive members. Nomination papers are available for anyone who wants them.
Very good.
And then I've included the Roselli Clark audit. Everything is there for your review. There's no findings, or no significant findings, or none that he shared with me.
Now, they would have been in that
Questions?
letter.
I'm sorry? It
They
would
would've
have been
been-
in the letter?
Yeah, they would have
Yeah.
been in that letter, so good job.
Okay, thank you.
Yeah. Okay. We need a motion to.
Accept and place on file.
Chair will entertain a motion to accept and place on file item 5.
So moved.
Been made and seconded. The director will call the roll.
Dan Stanhope,
Yes.
Dave Keane,
Yes.
Diane Smith,
Yes.
Bill Taylor,
Yes.
Greg Brewster.
Yes. Does carry 5-0. Item 6, financial review.
I just want to make a quick correction, so probably an obvious one. You're not going to be reviewing the April 2020 accounting. You received the June 2020 accounting.
Okay.
Nothing unusual so far, or nothing of concern to me anyway.
Any questions on the financial review as submitted? Hearing none, the chair will entertain a motion to accept and place on file.
So moved.
Motion's been made
Second.
and seconded to accept and place on file. The director will call the roll on the motion.
Dave Keane,
Yes.
Diane Smith,
Yes.
Bill Taylor,
Yes.
Greg Brewster,
Yes,
Dan Stanhope.
Yes.
does carry. 5-0. Item 7, miscellaneous correspondence.
PARAC just published its investment report. I think you ranked about, I don't know, 32nd, 31st, so you're in the top third of retirement systems for 2019. And I also included the PARAC memo regarding board member training, in case some of you need to get credits.
Okay. Okay, we need a motion to accept and place on file as submitted.
So moved.
Motion been made and seconded.
Second.
I will ask the director to call the roll on item 7.
Diane Smith,
Yes.
Bill Taylor,
Yes.
Greg Brewster,
Yes,
Dan Stanhope,
Yes.
Dave Keane.
Yes.
motion does carry. 5-0. Item 8, approval of warrants under tab Q.
This is just the payroll, the cover sheet for the payroll warrant for July 31st and the 2 warrants for August 1st. Greg will sign them, and eventually all of you will sign them when we meet in person.
Someday.
Someday, I know.
So we need okay, we need a motion to accept as submitted and place it on file.
So moved.
Second.
It is seconded. I'll ask the director to call the roll on the approval.
Bill
of the
Taylor,
warrants.
Yes.
Greg Brewster,
Yes,
Dan Stanhope,
Yes.
Dave Keane,
Yes.
Diane Smith.
Yes.
motion does carry. 5-0. Number 9, motion to adjourn.
So moved.
Motion been
Second.
made to adjourn and seconded. I will ask the director to call the roll at 9:33.
Greg Brewster,
Yes,
Dave Keane,
Yes.
Dan Stanhope,
Yes.
Diane Smith,
Yes.
and Bill Taylor.
Yes.
motion does carry. 5-0. Thank you, everyone. We stand adjourned.
Thank you.
Everybody take care.
Thank you.
Yep, you too.
Thank you.